Hey guys, what's up? Alec back with another stock market investing video. Today we're going to be talking about big tech stocks, the earnings they've had. We're going to be talking about the stock market crash, and specifically we're going to be talking about Apple, Amazon, Facebook, and Google stocks. So those four stocks are going to be the topic of today. They just reported earnings and they're down big. There you'll see Facebook's down almost 7%, 6.3. Tesla down another 5%, Apple down 5%, and Google's the only one up that's 3.8%, but in pre-market it was up 10% and it dropped all the way to 3.8%. So the question is, should we buy these stocks now? Should we have them on our radar? And what are we doing in this market right now? Should we buy during the crash? Should we sell? Should we hold? So let's answer all those questions and let's get right into it as well. All right, so here's some of my notes about Apple, guys. Apple reported the weakest earning out of the four that we just went over: Apple, Amazon, Facebook, and Google. And Apple's down big even after they reported earnings. The iPhone delay probably played a huge role in it. And also with the whole bear market and the crash going on, that's a big indicator that the market's weakening, even with all these huge companies reporting positive earnings and the stocks are still going down. So next we'll see iPad sales jumped about $2 billion quarter over quarter, which is always a phenomenal thing. But remember, Apple's big thing is their iPhone. And the next point we have is Apple has a very, very good balance sheet. So it is a safer company. I'm going to pull it up right here. So you'll see Apple's balance sheet 2019. It has $338 billion in total assets. But what you'll see in the past couple of years, Apple has been adding up the debt, the liabilities. So here you'll see in 2015 it was only $170 billion, and just from 2015 to 2019 they've added over $100 billion in liabilities, which is always not the best thing too. Now, remember, Apple's big thing is with all 5G. It's 5G phone, 5G this, 5G that. So in my opinion, 5G can be a really big thing, or it can turn out and be flat and fall on its face and be nothing significant at all. So I would read through a few of these articles. I just typed in 5G all hype. If you want to take a look at those and see if 5G is actually worth it, or if it's just all hype too. So these are some good things to look at, especially when Apple's new iPhone 12 is all about marketing on the 5G aspect of the iPhone. So here we have Apple stock down 5%, about $6. In my opinion, I think if Apple gets closer to the $100 per share mark, it's going to be something you're going to want to start considering investing more money into. A lot of people are saying that their big growth days are behind them. So don't expect anything crazy like we've seen from in the last 1 year from Apple. I think it's like tripled its stock price. But, an average of, I can see it growing about 10-15% per year for the next few years, or even 20% per year too. So keep in mind, Apple is a freak company. They're a beast company. But I think they're going to be more attractive around the $90 to $100 mark. And that's when I'm going to be putting a little bit more of my money in Apple. But remember, always have a balanced portfolio and don't let one stock attribute too much money into your profile. So here you'll see my profile diversity. We only have about 3% of Apple shares. And that's just on my Robinhood. And overall, people are saying they don't think the iPhone 12 can sell too good right now, but I think it will sell good just because they've had record numbers of pre-orders in India, I think it was, and also that a lot of people haven't upgraded their iPhone in a while. There's a lot of people with iPhone 10s, iPhone 9s, iPhone 6s, iPhone 7s. So I think this will be a good year for a lot of these Apple consumers to actually upgrade their phone and see a little boost in sales too. So here you'll see a Forbes article. Valuation is stretched. Growth rates for full year 2021 are even more prominent. Analysts estimate earnings of fiscal 2021 to raise by 20% to $3.90, with revenue growth of almost 14% to almost $311 billion, right? So those significant growth estimates have helped to push Apple stocks to the high valuation in years nearly in a decade. So keep in mind, the market does price a lot of this stuff in too, especially when you see numbers like this. but I think that Apple will grow around 15, maybe even 20% of revenue in 2021. But then if you go on to read the article, it says analysts currently estimate a significant slowdown in earnings growth in 2022 to 9%, while revenue slows by 5.3% in 2022, which is what I was saying, that their big growth days are going to be kind of behind them, and they're still going to be a good company to invest in, but it's not going to be like tripling its price or doubling its price every single year. But if we can see 15 to 20% revenue gains, it's very good for a company to grow by that amount. If we only see a 5% revenue gain in 2022. So the next one we have to talk about is going to be Facebook, the FB. Here are the most important numbers from the report compared to what analysts were expecting. So the revenue was 21 billion versus 19 billion that was expected. So they beat by a long shot, couple billion. Earnings per share was $2.70, where they were expecting earnings to come in at $1.91, which they almost beat it by a whole dollar on their earnings. Monthly active users, this one's really important. So it came in at 2.7 billion versus 2.7 billion that was expected. So they didn't beat that by much, but that's important to see that their monthly users, active users, are actually a little bit more than expected. Now, the daily active users are 1.8 billion compared to 1.7 billion, which again is very important, just like the monthly users. One thing that's important about the daily users is that it's up 12% year over year, and 21 billion in revenue for one quarter, guys. That's a large amount in a very large company we're dealing. Then the article went on to say the company saw 22% growth in advertising revenue for the quarter, and year over year to over 21 billion in advertising revenue. So Facebook, you guys know I love this one. I'm up about 31%, even with all the big crashes going on and everything. We're still up on this one. And I like this stock anywhere from $250 all the way to $220 to $200 a share. If you can get in at 200 to 250, that's going to be awesome for a long-term hold. I would hold this one for anywhere from 2 years to 5 years and see some awesome gains of about 15 to 20% or more per year as well. So Facebook absolutely killed their earnings, but Amazon destroyed their earnings, with sales skyrocketing 37% year over year as tech giants further enriched itself as one of the biggest beneficiaries of the coronavirus pandemic. So here's the numbers. Earnings came in at $12.37 per share when they expected $7.55. They almost doubled their expectations on earnings, which is, you'll never really see that. That's like a freak company, Amazon. Their revenue, you'll see, is 96 billion versus it was 92 billion expected. So they beat almost by $4 billion. The net income was pretty much on target, 6.8. Revenue increased about 35% this quarter. Amazon's absolutely a freak. 35% for a revenue increase is absolutely tremendous. So here you'll see the stock has surged 76% so far in 2020 compared to the S&P gains of only 3.2%. So that's an absolutely ridiculous amount. So this is important to know as well. Its core retail business will continue to grow, analysts say, with Americans largely stuck at home during the pandemic. Just this week, Amazon plans to announce 100,000 seasonal workers to support the holiday season shopping. So with that being said, Amazon is down $174, about 5% today. And I think we'll continue to see some hits on these big tech stocks. But overall, I would say that Amazon's going to be a nice pickup, anywhere from $2,900 all the way to $2,700 for the long term. And I would never sell this stock. I would hold it for 5, 10 years, even if you can. This is going to be a great one for long-term growth if you can pick it up around $2,700. This is just a free company that is taking over the world, along with all these other 4 stocks that we're talking about. Absolutely freak companies that are just destroying earnings. So that brings us to Google beats Q3 expectations, advertising and cloud revenues soar. So here we'll see revenues was 38 billion versus 35 billion that was expected. So they beat revenue about 3 billion, which is, remember, huge again. Earnings per share came in at 16 versus 11, which was expected. So they did kill earnings, and that's why we did see them shoot up about 10%. Now, Google's cloud platform brought in 3.4 billion in the quarter compared to 2.3 billion in the same quarter last year. So year over year, that's some huge growth. The company is jockeying for positions in the cloud wars behind Amazon, the market leader, and Microsoft, which is second place. YouTube, meanwhile, saw revenue of 5.04 billion compared to 3.8 billion in Q3. So YouTube revenue, a lot of people forget that YouTube is owned by Google. So all that revenue coming from YouTube is going straight to Google as well. It's part of the Google. Now, Dropbox, that brings us to, can be a huge player, and that's why I love Dropbox, is because it is in that cloud platform industry. So it's always good to see huge growth in that sector like that. Now, in my opinion, Google does have one of the best valuations out of the four, current price of where it sits at. But I would like to get in around 1,500 or 1,400. I would wait a little bit and just hold this one for a super long time. And even if you look at about 1 year ago, it's still about 1,500. 1,300, 1,500. So all the other ones that we went over today, Apple, Amazon, Facebook, if you look at where they were about a year ago, it's nowhere near to the price they're at today. So Google is one of the ones I think is at a pretty fair valuation. But if we can get it at $1,400, that is the price point I'm looking for. So let's go over some honorable mentions, and then we'll go straight into my overall thoughts on the stock market right now. So Pinterest is a great one for an honorable mention. Quarter earnings, 0.13 per share, beating its earnings of 1 cent per share. This compares to earnings of a cent a share a year ago. So the figures are just adjusted for non-reoccurring items. This quarter report represents an earnings surprise of 1,200% from a year ago. So revenue was posted 4,400 million for the quarter end September 2020, surpassing the Zacks consensus estimate by 11%. This compares to year ago revenues of only 279 million. So here we have the revenue for Pinterest, ticker symbol PINS, pulled up. And you'll see in 2016, their revenue was only 298 million. And then in 2017, it was 472 million, which it grew by 58%. And then in 2018, it was 755 million, which was a 59% increase year over year. And then in 2019, they reported a $1.1 billion revenue, which was another 51% increase in revenue. So this company's been growing revenues by 50% year over year since it's IPO'd. Now, if we scroll down and look at Pinterest's balance sheet, which is really attractive as well, one of the best balance sheets I've seen, you'll actually see in 2019, its total assets were 2.3 billion, while their total liabilities were only 360 million. So anytime a company has 4 times the assets as liabilities, that's always a really good sign, and I love to have that company on my radar. Even if it's 2 times the more assets than liabilities, it's still on my radar. So for it to be 4 to 5 times the amount, that's super, super attractive on a balance sheet. Now, real quick, guys, let's pull up Apple and all the other ones and go over their income statements and balance sheets real quick. So you'll see with Apple, ticker symbol AAPL, their total revenues grew by 27% in 2015, and then they had a little bit down of 2016. Then they grew about 6%, 15%, and then in 2019, they lost about 2% in revenue. So they're kind of stuck. It looks like they're a little bit capped at that $260 billion revenue. And it would also be interesting to pull up a 2020 income statement for Apple as well and see how they've grown since 2019. Now, if you look at their balance sheet, remember how we just looked at Pinterest and it looked phenomenal. It was like 4 to 5 times the amount. Here we'll actually see that their balance sheet in 2015 and 2016, they didn't have as much liabilities, But if you fast forward to 2019, like we already talked about, they grew their liabilities by a lot, almost 100 billion just in a few years. So here we have Facebook, ticker symbol FB, and people ask me why I like Facebook. So you'll see right here, they've been growing revenues consistently. They were only at 17 billion per year in 2015, and they spiked at 54% all the way into 27 billion. Now they're at 40 billion in 2017. 2018, they still had a 37% increase in revenue, and that brings us to 2019, where they did 70 billion in revenue, which was a 26% increase year over year. So anytime a company has double-digit increases in revenue, 10%, 15% or more, that's a very good sign. And this company's been growing consistently by 40, 50, 30% consistently every year with the revenues. Now, if we go down and look at their balance sheet, again, what do we say? We want to see more assets than the liabilities. And what has Facebook proven year over year for the last 5 years? That they have significantly more assets than their liabilities. So even in 2019, you can see that they had 133 billion in assets. So worst case scenario, and it hits the fan and stuff goes crazy, they're going to have enough cash and liability and assets to make up for those liabilities and debt that they owe. They only have 32 billion in liabilities. And that number is about, what is that, like 4 to 5 times the amount of assets than liabilities, which is super attractive. So we already went over that Amazon's an absolutely growth machine, but if you look at the percents, Facebook is in the last 5 years have grown a little bit more than Amazon. You know, this has been the breakout year from 2019 to 2020. But what we'll see starting in 2015, you'll see it was at 100 billion, and then it shot up 27% in 2016. It grew by 30% in revenues in 2017, and then in 2018 it grew by another 30%. And then that brings us to the 2019 where it was 280 billion, which means that it grew by 20%. And for Amazon, if you go back a little bit earlier in the video, you'll remember that they did 96 billion just in one quarter, guys. So remember in 2015, they did 100 billion all year. So once we see the 2019 to 2020 revenue is really when Amazon was able to take off and show some extreme growth. Now their balance sheet, you know, they do have some good assets. They have $220 billion in assets, but look at their liabilities. They also have 163 billion in liabilities, which isn't even as twice as many assets as liabilities, where Facebook is stomping them with their liabilities and their assets. So that brings us to Google, ticker symbol GOOG or ticker symbol GOOGL. It's pretty much the same one, either one you look at. But what we'll see is some good revenue growth, about 20 to 15% per year consistently, year over year. So it's good growth. And the company hasn't even grown, I don't think, 20%. Their stock price hasn't even grown 20% year over year. So in my opinion, this is one of the most fairest valuations, which I was saying earlier in the video as well. Because if you look at their balance sheet, in 2019, they have 270 billion in assets, which is almost the same as Amazon. But look at their liabilities. They only have 74 billion in liabilities. So if anything bad happens and the market, everything closes and they don't have any income, zero revenue, they're easily able to pull their debts and liabilities back. They can pay that back very, very easily. And they have anywhere from 3 to 4 times the amount of assets than liabilities, which again is that magic number, anywhere from 2 to 4 times the assets as liabilities. Then I start getting interested in the stock and I want to buy that stock, especially when they're showing year over year growth of revenue consistently every single year. All right, guys, so that brings us to my overall thoughts on the market right now. And the first note I have is all 3 indexes are falling. You know, the S&P, the NASDAQ, the Dow Jones, and then gold's falling, silver's falling, Bitcoin is falling. Even with all these positive earnings that companies have actually reported, we're showing some real weakness in the market. Next is Europe actually imposed restrictions France is shut down, so that's a huge thing. Coronavirus numbers keep upticking, and we can be at 100,000 new daily cases in a few weeks here. We're 4 days away from the election, so it's very, very close with the election coming in. And whenever after the election, after November 3rd, it's always been a little bit down in the market. We've seen a little bit crash coming. I would say don't stop investing. Don't be scared. This shouldn't be the reason you stop investing, but you should always have 20 to 30% of your money in cash. Never put 100% of your money into the market. Again, election day is November 3rd. We saw the biggest single day fall since March for the Dow Jones, which is a scary thought. Is the biggest single day fall. So for all we know, next week can be a slaughter. Monday might come in not that bad, just to like get everyone on their feet and everyone to put more money in. And then Tuesday, Wednesday, Thursday, Friday could be an absolute slaughter in the market. But that just means that we have a lot of buying opportunities in the market right now. Like we went over some price points. The next video I'll put out either tomorrow or Monday will be about 20 stocks, maybe 15 stocks on some price points to watch every single one of these stocks. So go ahead and leave a thumbs up on this video if you do want to see that video with about 15 different stocks with some buying opportunities in the market. And that leads us to there's a lot of fear in the market right now. There's no way around it. Everyone's fear-mongering, saying, oh, if Trump gets elected, this is going to happen. If Biden gets elected, this is what's going to happen. And the fact is that typically the market goes up no matter what party's elected. So don't be fearful over that. Don't listen to the fear-mongering. And the market is likely to go down over the next 2 months, though. We have seen some real weakness in the market. It's always a bad sign if there's good news, like good earnings, for example, and you see companies losing percents. Like in this video we went over, the companies are down 5%, 6%, Facebook down 6%, Apple down 5%, Google lost from 10%, now it's down to 3%. So a lot of real weakness in the market, and that's always a good sign that we are seeing real weakness. That's a huge indicator is if the market's crashing and the companies are reporting good news. So that's the whole video on big tech. I hope you guys did like it. Smack a like button, hit the like button, go ahead, and helps me out a lot. It only takes 1 second out of your day. Subscribe on YouTube, and we have an absolute banger of a video coming tomorrow or Monday about 15 price points and 15 opportunities, buying opportunities in the market, 15 different stocks to actually look at. So comment below on what stocks you're watching. If you guys like this video, if you want to see more like this, subscribe. And if you guys need some help, go ahead and reach out to me. This is a great time to get into the market. You shouldn't be sitting on the sidelines right now. This is the #1 time. You're going to be buying in at a lot better prices than other people were buying in a month or 2 months ago. So if you ever thought about investing, now is definitely the time to get in when the stocks are low. So guys, hit the like button, comment below, share with friends. Until next time, don't time the market, buy the market. Peace.